Continuing on with utilizing all the principles that we've learned and putting them into practice using various charts, various time frames, various different instruments, I'm now throwing a curveball out. There's no label on this chart. We don't know if it's an exchange traded fund, if it's a stock, or if it's the S&P E-mini futures contract. It makes no difference. We're going to go through the chart the same way we've been doing in the last several lessons, identifying all the areas where the technical aspects and all the principles that we're learning get put into practice, and you can see how and why a chart moves in a specific direction at a specific time. This chart is chock full of goodness in terms of allowing us to see the principles that you've learned in action. Once again, let's take it from the top. I've put a line on the chart at $71.93. The first thing we want to do is go up a time frame, and I'm not telling you what time frame this is. This could be a 10-minute chart, it could be a weekly chart, it could be an hourly chart, it could be anything. We're going to go up a time frame just to see why this instrument found resistance at that level. Now we're on a different time frame, we're on a larger time frame, and the blue circle depicts the same area we were just looking at. So even as we go forward, after that resistance point occurred, you can see how the chart respected that same level again. When a chart respects a price level over and over and over again, that's the chart's way of telling us that that price level is important. But what about if we go back in time? Are we going to find the same price level respected on the chart? Well, let's roll back the clock and see what we find. As we go back in time, you can already see another candle that came in to touch that line and bounced right off of it. Let's see if there's any more as we roll back the clock. There we go. You can see why this level is important. You can see how the chart respected this level in here, it got over it and failed, came back in, tried to get it again, didn't happen, came back down, tried again. And this could be, if it's a short-term chart, this could be a half an hour, this could be 40 minutes. If this is a daily chart, this could be a week. If this is a weekly chart, this could be a month or 5 weeks. It's all relative and all in proportion. So that price level is important on the chart. We need to respect when the chart tells us a certain price level is important. Let's go back to the original chart at the original point in time and see what else we can find to support the principles and the learning process. Now that we've established the fact that this price level is important, we know that if the stock were to come and approach this price level again from the underside, it should provide resistance. If it were to get above this price level and come back down, it should provide support at minimum of a temporary basis. Following the stock being rejected at that price level, it starts to come in. The stock changed character, changed trend, and began to trade lower. It traded lower for a number of candles. In this case, it was 9 candles before a reversal. Our sweet spot is between 6 to 7 and 10 candles. We're looking for a signal of a trend change in that zone. That's a time zone. Whether you're looking at a short-term chart or a longer-term chart, it's still a time zone we're looking for a trend change, but we never guess that an instrument is going to have a trend change. We wait for the signal. In this case, what did we get? We got a doji candle. That's a signal of a trend change. It also happens to be at an area that this chart found support before it broke to the upside. So we have 9 candles down, could have been 7, could have been 10, but it's in the sweet spot into a prior support area and put in a signal of a trend change. You have multiple reasons why you could be expecting a trend change based on all that information. And the best part is, if you take a trade based on that information after the doji candle completes, you're buying the instrument on the long side and you know where you're wrong. Where are you wrong? Any close below the low of that doji candle. If you're working on a 10-minute chart, it's a 10-minute close below. If it's an hourly chart, it's an hourly close below, and so on. Now the instrument puts in a large up green candle. That's generally telling us that it wants to move higher. So including the green up candle, it goes sideways for 6 candles and breaks higher. However, it was what we would call, and we can only see this after the fact, a failed breakout. But let's say that we were long this particular instrument. Now, where would be our stop out? Originally, the stop was below the low of the doji candle, but once it put in a large green up candle, we can move our stop up to the bottom of the large green up candle. Why? Because we know any close below the low of the green up candle breaks apart the bullish consolidation pattern, and therefore the reason we would have taken the trade on the long side is no longer available. Therefore, we would have to move out of the trade. As you can see, we got a candle close below that low. Therefore, the pattern is off the table. Therefore, we're out of the trade and we don't take the ride downward trading on hopium. Our first loss is generally going to be our best loss. Now keep in mind, every trader is different and every trade is different. We may have taken a trade up in this area and we may have taken a profit. We may not have been stopped out of this trade. It all depends on the objective of the trade. If the objective was a short-term scalp trade, that's fine. If the objective potentially was a longer-term swing trade that would last multiple days, then that's a different trade altogether. On a swing trade, we're looking for more gain. We're giving the instrument more time to bake in the oven, and just like a loaf of bread, we're giving it more time to rise. If it's a scalp trade, we may have been out of this trade long before it closed below the low of the big green up candle. So we have a failed bullish pattern and the instrument begins to come down. It comes down and what happens? It starts to go sideways for a while. And it goes sideways until what? Until it breaks down again. And so therefore, what we've seen here is essentially from the top, we saw a down move, a bearish consolidation pattern, and another down move. And that's looking at it from a larger picture. This is what we call a stair step lower. It all depends on your time frame. Within that stair step lower, there may have been 2, 3, 4 trades on a short-term scalp trading, day trading basis. But when you look at this from the bigger picture, you can see how the chart was stair-stepping lower. See, even within a trend, you're going to get counter-trend bounces. Let's say this is a daily chart. There's going to be plenty of opportunity on an intraday basis using, for example, a 10-minute chart where you can find plenty of trades even if the overall trend is lower. It's certainly easier to trade with the trend. However, you can certainly find counter-trend rallies within a downtrend. Nothing wrong with that. When the chart tells you you're at support until proven otherwise. Next item on the chart that we'll point out is what I like to call a pseudo doji candle, which in this case is also a tail candle. Like before, these candles are indicative of an ensuing trend change. And in this case, you have 2 additional items in your favor for a trend change. Number 1, you have volume. The red line right underneath this tail candle, this is all volume down here. This is a spike in volume. So when you see a tail candle at a low on a chart on volume, that's the chart's way of telling us it's in for a trend change. What's the best part about a tail candle at a low on a chart? We have something to trade against. If we're looking to buy the instrument on the long side, we know where we're wrong. Any close below, any candle closes below the low of this tail candle, and we stop out of the trade. It's that simple. So once the tail candle was developed, we're looking for some kind of a retracement. In order to get the best price, we like to see a retracement. Doesn't happen all the time, and you're never going to get the type of retracement you want each and every time. Sometimes you'll get a 50% retracement, sometimes you'll get more, sometimes you'll get less. This one looks to be even less than a third of a retracement of the total of the pseudo doji candle. But it's certainly a reasonable risk-reward setup. You can hop on board on the long side and ride it higher. Now let's see how this instrument acted and reacted based on our Fibonacci retracement levels. We've got our fibs on the chart, and there's a couple of things I want to point out immediately that are important. This instrument was getting into what I would call an oversold condition, being down this much in this period of time. But what you'll note is an instrument, whether it's a stock, a futures contract, or anything else, can always go a lot lower and a lot higher than most people expect. So be careful when you hear oversold or overbought. It can be true that something is oversold, but it doesn't mean it can't go down farther. So we never take a trade based on if we think something is oversold, or we never take a trade based on if we think something is overbought, because you never know exactly how high or low an instrument can go. But we do have something else that's very interesting that I want to point out. We have another round number. The bottom of this tail candle found low and reversed right on the money at $50. That's a big round number. 50, 100, 25, 75. These are spectacular round numbers that a market will respect over and over and over again. It's a psychological number. It's a round number. It just works. It pierced through $50 by 7 cents and reversed on a dime. After the reversal, what happened to the instrument? It went up to, and immediately went up to, the 25% retracement, and as you can see, found resistance for about 4 candles. Maybe it was 40 minutes, maybe it was 4 hours, maybe it was 4 days, maybe it was 4 weeks. It's a period of time, and it's telling you that the chart is respecting that price level. It consolidated for a period of time before pushing higher. When it did push higher, where did it go? Right to the 382 retracement on the button. Then what happened? Pulled back. Where did it go? Right down to the 25% retracement. Even pierced through it a little bit. Then it went right back to the 382, and it couldn't get through. And what did it do? It put in a pseudo doji candle, which is an indicator of an ensuing trend change. Then the instrument had a pretty deep pullback, and anybody that would have been long in a case like this wouldn't have stayed long into the deep pullback that occurred all the way down here. It was a normal garden variety retracement from low to high, and I'm referring to this pivot low to this pivot high. This was a retrace that came within or in between 618 and 75 retrace of that move. However, nobody would stay long through that. You would be trailing a stop loss. You would be taking profit along the way, and we're going to get into that in another video in this course. That's trade management. And then you can see that this instrument acted the same way as every other chart that we've looked at so far. It respects all the Fibonacci retracement levels. 2.5 retrace, 382, busts through and stalls out at the 50% retrace, finally gets up to the 618, pulls back to the 50% retrace, continues back up, stalls out at the 7.5 retrace. All charts, the majority of the time, act the same way. And that's why I continue to pound home the point that it doesn't matter the time frame. It could be a short-term chart or a long-term chart. It doesn't matter the instrument. It could be the S&P E-mini futures contract. It could be the NQ contract. It could be crude oil. It could be a stock or an ETF. It makes no difference. That's why we don't have a label on this chart, and you can see they all act and react the same way, over and over and over again. The more you see this, the more you learn, the more you'll get comfortable with the fact that you can expect certain things to happen based on a chart acting a certain way. Without a doubt, repetition is the mother of all learning. I obviously didn't make that up. However, it is an absolute truism. I know that each and every one of you at this point can identify certain things on the chart that you couldn't identify before because you're seeing them over and over and over again. And as a result, it makes more sense over time and you get more comfortable with the expectations of what an instrument should do.